On today's episode, we have Nate Shields, who is an investor and loan broker out of Colorado.
We've raised $14 million in the last year and a half. We're getting these newer properties for $125,000 a door, and we're getting, $1,100 in rent.
He has an impressive multifamily portfolio with 264 units. Nate, thank you for being here.
Thanks for having me, Vince.
All right, so you are in Fort Collins, Colorado. Is that right?
That's right.
Awesome. How long have you been doing real estate so far, and what were you doing before that?
Yeah, so I got my start in real estate in 2013. I was really wanting to make a change, so kind of the origin story, so to speak. I was doing a marketing job that I really didn't like. It was just something I was able to find out of college. Did that for way too long, and eventually kind of needed a change. The Great Recession came around. My pay was cut, my hours were cut, and I kind of needed to find, a solution, not just for, financially, but what's going to, actually mean something to me. Like it didn't feel like I was making an impact. I didn't want to grow in the company, things like that. So, like a lot of people, my wife and I were sitting on the couch watching HGTV, watching Flip or Flop and all those shows. And I'm like, I could do that. And I said that for years. Right. And so, I was talking with a friend of mine and I was like, I'd really like to at least take a look at getting into real estate. Do you know any realtors? And he gave me the name of a guy. We had coffee and he talked me out of it, to be honest. Like he was like, you know what, it's risky, it's expensive. You got desk fees and you got these fees and realtor fees and all this stuff. And at the time I was really just wanting to dip my toe in, like, go part-time, just see if it was a fit, maybe make a little extra cash. And if it was, I would go, all in, but, it seemed risky at the time. So probably another year went by and I saw on LinkedIn in my alumni group that someone was posting about doing real estate part-time. And they were local. And so we had breakfast, we hit it off, and 4 months later I was licensed and kind of, got off to the races. And so the end of 2013 was when I got licensed. And my goal was within a year to go full-time because it really did feel like a good fit to me. I had more control of my time. We had just found out we were pregnant with our firstborn. And so I really wanted to have that flexibility that I saw could be possible in real estate, especially as an agent, to have more time with the family and, make a better income too. And so, the goal was a year. It took me 6 months to close my first deal, but then just 2 months after that, I had enough in my pipeline and enough saved up that I made that leap. And it was, what I kind of say is probably the second best day of my life up to that point was, quitting my job. I was like, because that's what a lot of people, what attracts a lot of people to real estate is, the financial freedom aspect of it. And that's definitely true. And there's different ways to achieve that. But that was the starting off point, and I didn't really find investing for a couple of years.
I found that there's usually some really interesting background with each person as to how they kind of built some foundational skills in personal development and business before they went into real estate that end up helping them in real estate that they don't fully realize the connection all the time. So I want to go back a little bit earlier before you started doing real estate full time. What was your relationship like with money when you were growing up with your family? What were those conversations like, and how did that feel?
Yeah, I mean, I would, as a kid, sometimes you are sheltered from some of that stuff. But, in retrospect and in speaking with my parents, we were lower, middle class, small rural town in northern Wisconsin. My dad worked, my mom didn't. She worked the first few years as a teacher, but then, was a full-time stay-at-home mom. And then she ended up schooling us too, because we ended up homeschooling all the way through after just the first few years in elementary school. And so foundationally, I didn't have a lot of exposure to it. It wasn't like it was closed off, but I never felt the stress. I'm sure my parents did at times, and they've told some stories around that for sure. Definitely, I would say that Probably the biggest part of it though was because, we grew up in a Christian household. It was like setting aside that 10% for tithing to the church, right? So I think that was like the first lesson about money, because when I was, even 5 years old, I was doing that. I'd have like 10 cents, that I could, put in the offering basket. So kind of teaching around that. And then we had a family business. I think that was probably the second thing that I kind of learned a little bit more about business. And it was really interesting because my great grandpa wrote a book back in the 50s, early 60s, somewhere in that range. And then a business kind of came out of that. And so we ended up having a publication business that was handed down from him to my grandpa and then to my dad. And so we as a family, we as a family ran that business, and it didn't take a ton of time. It was maybe, 5 to 10 hours of work for me personally. And mostly I was just taking orders, packing them up and getting them to the post office, things like that. So it was kind of my first glimpse into that. And then my dad at the time also was self-employed. So it was like we had this family business and he was self-employed. So I kind of saw some of the freedom, some of the upsides and downsides of that. Plus, I think being homeschooled, there's so much flexibility there. It's like, hey, just get your work done. And I would usually get done by, noon, 1 o'clock, and then I could go do whatever I want. So I had so much flexibility, and that was also modeled in the home, that it kind of ruined me for being an employee, right? So kind of set the foundation for getting into entrepreneurship. And then fast forward to like when I graduated from college, I really didn't know what I wanted to do. I just kind of believed that old lie of, you go to school, get a degree, and then a job's going to get handed to you. And in a sense, that's true. That's kind of what happened, but it was a job I didn't like and didn't provide the way I wanted it to provide. So I had to look at some other stuff. So I looked at some different businesses, thought about starting my own businesses, had a couple of false starts there. But that's when I read, Rich Dad, Poor Dad, Cash Flow Quadrant. That really at least accelerated the thought process of what was possible and what might be a better fit for me. Now, it still took me a long time of some failures and some false starts and things like that. But eventually, when I found the right, thing for me, being real estate, then it really accelerated from there.
I've got a couple of really interesting questions before we get into Rich Dad, Poor Dad and thinking about real estate versus businesses, because I do want to dive into that and I want to understand what happened with the business exploration phase. But first, on the college front, really interesting question here that I've never asked anyone. You were homeschooled and then you went to college. What was that experience like?
Well, I was scared at first. It's like, okay, the work that I've done, is that going to be enough? I felt like I probably had some pockets of knowledge, because it's like your parents can only do so much. And my dad was working, so my mom did her best. But it's like when it came to the sciences and stuff like that, which I wasn't even really that interested in, I had some shortcomings there. But everywhere else, it was, more about how do you learn? And I think that's a more important thing to teach kids, is like, how do you learn so that when you actually are interested in something, you can latch onto it and, learn as quickly as possible, as much as possible. And I didn't have YouTube University back in the day, podcasts and stuff like that. So you kind of go at it the old school way with books and learning from people. But yeah, I was scared, but I ended up graduating, I think 5th in my class. It wasn't a huge class, but magna cum laude. Was very involved at school, did a lot of cool stuff on some leadership teams. I was a resident assistant. So it was a great college experience, and I certainly wouldn't trade that for the world. But I also, looking back on it, the degree itself didn't really serve me. At the time, it was what I was interested in, but I knew a couple years into it, I didn't want to do it vocationally either. So.
And what was your major?
It was Christian religion and philosophy, and then I had a double major in psychology. So I got more interested in psychology and thought maybe I could go that route, but I'd have to go get at least a master's, But once I was graduated, I was like, you know what? I'm not going to go into that right away. I'm going to take a year off, work a little bit, see what's up, and really never went back to school. At that point, I wanted to focus more on, career.
I'm really curious after you read Rich Dad Poor Dad how you started to think about businesses versus real estate, because a lot of people read that book and they come to the same conclusion. You can either build wealth in the United States with one of two ways. You can either buy real estate you can either buy real estate and invest in it, or you can buy businesses or start them. Sometimes people will start off on the business track, not like it, or have success and sell a business and then go into real estate, or vice versa. But those are ultimately the two paths that you have to pick from. How did you work through that process of deciding what path you were going to take?
I think some of it was just like self-discovery, and then some of it's like self-awareness and just figuring out what works and what doesn't work. But the distinct thought that I had from those books was it would be so cool if I could just own 20 houses. Like that was the distinct thought. Like I don't think he mentions that number or anything like that, but it was like so easy to understand. That's why so many people do gravitate toward real estate. Everyone has either rented or owns a home, and they understand that this part covers the mortgage. Anything else is gravy. House prices go up, you get cash flow, all that stuff. It's so basic. And it's like, all you need to do is find a way to get into those properties. And then the tenants are paying down your debt for you and all that, good stuff that people like about real estate. So even though I tried, a couple businesses and startups and just ideas, right? It wasn't anything like huge. I didn't buy a business or anything like that, but just kind of exploring, tasting things, which I think is great to do in your 20s, especially if you don't know exactly what's going to be the right fit. And so through that, it told me, yeah, not necessarily business, but real estate is definitely the thing that kept being the common thread through it all.
What was the most embarrassing business failure that you had when you were going through that experimental phase of trying some things?
So this goes back to me and my buddy, who's still my partner in all of this. We started a business. This was around the time or right before Groupon came out, right? But we were doing it in a non-digital way. So what we did is we went to different businesses. We got discounts at those businesses, and then we put together these really slick looking things. It was we wanted it to look like like the unboxing of an Apple product, just really slick, glossy, all this kind of stuff. And so we bit off more than we could chew with that. We did get all these great discounts, but then it's like, how do we sell them? And so we hired some high school kids to go door to door, and just, we didn't know how to train them. We didn't know sales scripts, like nothing. And so we both put in so much money just in the making of the product itself, because we had to go through, like a printer. So I think we each put in like $5,000 or something like that. And it completely bombed, because we didn't know, like we kind of had that vision, and had we maybe made it digital like Groupon did and made it more accessible that way, or we just had better sales skills, like this is how it's gonna work, done a better job of training the kids, whatever it was, could have done something. But that was the first time we did anything together in a business sense. And it wasn't long after that, it was only a year or two after that, that we had like that initial talk of what about real estate? And really how that happened was, I had been an agent for close to 2 years at that point. I had just found bigger pockets. A property manager friend of mine texted me the latest podcast episode. This was back in 2015. And it was around episode 100, 105, so somewhere in there. So I was on my way home from a showing, put it on the car radio, and I was just completely floored. Like I had sold probably 40 or 50 houses at this point, but I had never been exposed to the investing side of real estate in a meaningful way. And when I listened to those podcasts, I just went all the way back, listened to everything back to the beginning. And so during that time, I talked to my buddy Troy, and I knew he was involved a little bit in some real estate with his family. And so I'm like, what are your thoughts there? I'm an agent, so I can scope deals. At the time, there were a lot of foreclosures and short sales and things like that. I'm like, how would we fund it? So we were starting to have those discussions. Of course, the most important discussion is what do we call the company? What do we call the LLC, right?
And you care so much about that when it like doesn't even matter.
It doesn't matter at all, but it was fun for us. And then we talked with a commercial lender that was a friend of his, and we're like, how can we go about this? Like at the time, the BRRRR method was really starting to take off. And so we were wanting to do that because that was the best way to like recycle money and do more deals. And really for us, we weren't looking to flip. We weren't looking to wholesale. We just wanted buy and holds. And so, we started off, got basically a line of credit. We got a multiplier like on our funds that we put with the bank. And we were able to take down our first property that we bought at auction. I think it was $62,000, put like 60 into it, appraised for about 150. So it wasn't a perfect BRRRR, but it got us, experience in the game. It got us experience on being property managers and just in with construction too, because we had to hire contractors, a big rehab, and it was probably a bit more to bite off than we should have, but we learned a lot of good lessons from it.
Real estate is a team sport. You can grow so much faster if you're in the right room. The Launch REI Mastermind is a curated space for investors who want to move from hands-on execution to professional portfolio management. This is your personal board of directors. Inside, our conversations go beyond the tactics. We cover the decisions that actually change outcomes, structure, tax strategy, and capital allocation. If you want to build alongside a vetted peer network designed for the long term, apply for the Launch REI Mastermind at the link in the show notes. And I bet in hindsight, you probably recognize that the lessons that you learned was more valuable than the money that you made. And you guys actually made a profit on that deal, which is fantastic because you may have lost money on that deal like so many people do in the early stages where they don't know a lot. And you're able to take that knowledge and compound it and apply it to everything that you do going forward. As long as your first deal isn't your last deal, you're going to get better every single time that you do it.
Exactly. Yeah, I always tell people your first deal is your most important deal, not because it's going to make you the most money, but because it gets you started, it gets you in the game. You start to learn some of those things, and then hopefully you're not making the same mistakes, next time. So I rarely see someone do one deal and never return to do another one.
Tell me about your first apartment building. What was the purchase price? How many units was it? How did you guys find it?
Well, that was interesting. So we bought a few properties in the Chicago area. So we had a few singles, a few small multis. Then my buddy moved to South Carolina and we sourced a duplex there. So we had, 6, 7, 8 units at that point after a couple years. And we were really wanting to scale more. And just buying singles and duplexes wasn't really doing it for us. And so we wanted to find something bigger. And so we were looking nationwide, really, just something bigger, like 8, 10, 20, 30 units, something like that, but something that we could actually afford too. And so my buddy found a property on LoopNet. A lot of people say that's where deals go to die, and there's some truth to that. And this deal had been on the market for probably a year, and the financials just looked terrible on it. And that's what really piqued his interest. He's like, how in the world could the numbers be this bad? And what had happened is basically it was mismarketed by the realtor. She wasn't really a commercial agent. She only took half of the income and applied it, to the listing because that's what she saw. And so, it was really double as good as what it was being marketed on the site. So once we saw the numbers, we're like, okay, this is actually a fantastic deal. Let's check it out. So this was in Alabama, about an hour west of Huntsville. And, we both flew into Nashville and then we drove down. And we knew a couple things, but we wanted to check on a couple things. Like there were a couple things we didn't know. Like we knew the condition of the property. Like it was a C property, nothing fancy. And we knew the numbers. So those are the things that we knew. The things that we did not know, we didn't know the area. So we're like, I don't know, is it a good area, bad area? Is it too small, too rural? Like what does that look like? And then will we keep the property management that's been managing this property? Because that can be a pretty heavy lift to go to a brand new market and then have to interview and trust property managers.
Yeah.
So, it's a 20 unit building. It was $500,000. I think it was listed for somewhere in the sixes. We ended up getting it for 475, and we were able to use 100% financing. So our lender underwrote, the 80% part of the deal. And then they also allowed us to use the line of credit we still had with the bank for basically the down payment. And it still cash flowed. So it wasn't like a huge risk, but it was 100% financed. And so that's how we were able to take that down. Because otherwise we were like, well, where would we find the funds, right? So that was the numbers on that. And then it immediately appraised for, I think, 675. So we got it for just shy of 5. And I think that our last appraisal was, I don't know, $1 million, 1.1, something like that.
How did you kind of learn the fundamentals of what your different financing options were and how you can fund deals and how you can stack these things and put them together? Because a lot of people don't know anything about lending or financing. And when you start to understand the different tools that are available, and I can use this source of funding for this portion of it and then this for the rest of it, where can people kind of get some ideas around how to think through that? And how did you figure that out?
Yeah, I don't know if we did figure it out. Like we were just talking with the banker, like, is this possible? And we'd worked with him in the past. So if he said it works, fine. And now on the commercial side, there's a lot more flexibility, especially if you're working like with a local regional bank, credit union, stuff like that. There's some downsides to that, but as long as it's not like a Fannie or a Freddie loan, there's a lot more hoops to jump through, which we've learned in the last couple of years when you're getting agency debt on a bigger multifamily property. But there can be a lot of flexibility. They can make a lot of exceptions. And, it's more of a relationship based thing than it is like an underwriting thing. Of course, they're still going to look at it and scrutinize it. But they kind of understand us and our business model, and having worked with us for years already, I think they extended that to us without any problem at all.
What went differently with that first multifamily deal than how you thought it was going to go?
Well, I think, kind of back to finish that story, we didn't know the area. Now, as soon as we got into the area, it's like there's a Publix down the street, there's all this shopping, there's a Target. It's like, it was a really nice, kind of a suburban feeling area. So we really liked the area. We drove all around the 4 towns there along the Tennessee River. And then the property manager was the other piece. So we obviously walked the property with him. He drove us around town. We had dinner with him. And that answered our second question, will we keep the management? Now, he had already been managing it for 7 years. So he knew everything about the building. And we're like, well, he's a nice guy. He's established. He manages a couple hundred units. We felt good. We felt good about it. And so that's why we ended up moving forward. Now, you fast forward to today, I mean, you can look at it as luck, but now we have 200 units in that market, and it's all because of our property manager. He is such a rock star. He's brought us our last 5 deals. It's just him having that knowledge, but it's also us. I think I heard this on probably a Bigger Pockets podcast or something. You just got to tell people that you're a buyer. And so like every quarter, we just remind them like, hey, we're buyers. If you ever, hear of something, know of something that's coming up, let us know. And now he really knows that we're buyers, so we don't have to really remind him. But, to get those next deals, that's what we did. We just reminded him. And I would say once or twice a year, he had something.
The ROI that you get on A players is so much bigger than B players. It's one of the biggest traps that people can fall into, because you might think this person is an A player. Maybe they should get paid 5% or 10% more than a B player, but they might actually be 10 times better and 10 times more valuable than a B player. So you have to do everything that you can to stack your team with A-level talent. And so this property manager brought you 5 multifamily deals. How on earth did they do this? Because they added probably hundreds of thousands of dollars, and in the future, maybe millions of dollars of value to your portfolio.
Exactly. And the way he looks at it and the way we look at it too, it's a partnership. Of course he's getting paid, but like I said, he was managing maybe 200 properties at the time. Now he's managing 650, and we make up about a third of his portfolio, right? So he gets to grow with us. And those are some of the chats we've had along the way too, is are you able to sustain this? Like, do you need to hire some more people? Do you need more vendors? And he has had to hire a couple more office staff and things like that to keep up with the volume and, the amount of things going on between all the properties.
I've never heard of a property manager doing anything like this. I've never heard a story like that ever.
Well, it's hard to find good property management. I think that's part of it.
How are they finding the deals? I mean, there's people that are full-time sponsors and general partners that can't find 5 multifamily deals in 5 years. And this property manager did it while working their full-time job managing these properties.
I mean, he's an investor himself, so part of that portfolio is his with a partner as well. So I don't remember how many units he has, but he has probably another quarter of the portfolio. And so he understands investors, and he also understands like timing is everything when it comes to investing. And so some of these projects, he was already doing development with his partner. So they're all in on that, but he's like, there's this great opportunity over here if you guys want to take a look at it. And because he has lived and grown up in the area his entire life, knows a lot of the people. It's not a huge area. I mean, I was just looking at some of the metro data. Between the 2 counties we invest in there, there's maybe 100,000 people. So it's not like a big market. It's very tertiary. Like I said, it's an hour from Huntsville. There's a lot of great stuff going on there. And that's, I think, where probably a lot of opportunities lie right now, and where they've been the last few years, is identifying tertiary markets that aren't getting built up like a lot of the major metros, right? If you're looking specifically at like multifamily, like cranes in the air, beware, right? So it's kind of like, where's the development, but also just where's the demand and where's the affordability? This part of Alabama and this part of the country, very affordable. We're getting these newer properties for $125,000 a door, and we're getting, $1,100-1,200 in rent, but they get a nice 2-bed, 2-bath, 1,200 square foot, less than 10-year-old product. And a lot of people enjoy that, and they can afford it.
What skills do you think that people really need to have before they buy their first multifamily property versus what things they can figure out while they're doing it?
That's a really good question. Because I think it's different for everyone. I always say everyone has some sort of unfair advantage. And I think I wouldn't have gotten into real estate investing without being an agent. I think that is the honest truth. Like, had I not already had 50 transactions under my belt, like I knew the structure, I knew lenders, I knew, contractors, I knew title reps, I knew home inspection guys. I just felt comfortable. And so part of that is just getting comfortable with one part of that. And that's why I'm always kind of preaching to agents. I'm like, you guys have such a unfair advantage in a good way. Everyone has some sort of unfair advantage, but you are talking with sellers every day. That could be your next investment property, access to the MLS, all those different things. And so I just think you got to look like where you're at. Like, I've worked with some investors in the past when I was an agent, and some are like super analytical. They want to get into it. So they're so good at the numbers, way, way, way better than I am. And maybe that'll set them into a little bit of analysis paralysis. But when they find that deal and they pull the trigger, it's going to be a banger. So I think it's just like figuring out what is your skill set. And then you have to take some leaps though along the way too, because going from like that 20 unit building to then buying a 55 unit and raising money from investors, that is way different skill set, way, way different. I think it's pretty easy to go from onesies, twosies to getting a 20 unit if it's still like your team, like it was just me and my buddy still, right? As soon as you're bringing in investors, different deal structure, 506B, 506C, it's like different attorneys, like different back end systems. There's definitely a learning curve there, but along the way, you also meet people, mentors and things like that, like that introduce us to our SEC attorney, things like that. So those relationships are what become very valuable as you kind of ladder up.
What's really interesting is as you're kind of explaining through this, it makes me think of two things in particular. One, kind of like a video game where you have skill trees where as your character levels up, there's these different categories. And so one category in this particular example might be capital raising. One might be how you're finding deals. One is certainly how you operate and manage the deals. One might be, managing the building itself. One could be managing the tenants. One might be how you're going to approach refinancing and recycling your capital. One might be finding partners. One might be building out your team, whether it's title companies, home inspection companies, contractors, like you said. So there's these different categories, and it almost sounds like if you're getting your first multifamily property, you only have to know maybe step 1 or step 2 in a couple of these different categories. But then when you go to your second or your third deal and you're scaling up and buying a much bigger property, you need to start hitting level 3, 4, 5, in some of these categories, and it fills out more in each of these different areas. Is that right?
That's exactly right. And I always say that, real estate is a team sport. You cannot be a lone wolf in real estate. Like, yeah, maybe it's your money and it's your idea to go buy that property, but you know how many people are involved in just the transaction alone? There's like 20 people that get their hands on the lending, the title company, the inspection, like all that stuff, the agent. And as you scale that, it becomes even bigger, right? So now we have 100 plus investors and we're raising millions of dollars. And so that's a totally different thing. Like you say, it's kind of that skill tree of figuring out how to do that. And how do you
guys are raising millions of dollars now?
Yeah, we've raised 14 million in the last year and a half.
I did not know that. That's wild. And you guys have 264 units currently?
Correct. Yep.
With that amount of capital coming in, is it all going into multifamily, or are you guys also putting money into other asset classes? Or is this just a big war chest for only multifamily?
So we have two different companies. So the one we started with, just me and my buddy, we still have that. We have like 74 units, I think. And that's part of that 264 unit number. And then the last 3 deals we bought is with our other company, Missional Capital Group, and that has investors. So that's either 506B, 506C type of raises and bigger properties. So kind of our sweet spot is like that 50 to 80 unit range in southeastern markets. And we're usually putting down, pretty healthy chunks for a couple different reasons. We usually put down 50 to 60% because we want cash flow, but we also want protection from the downside. Especially the last couple of years, interest rates have been so high, and so it's hard for deals to pencil, but it gives us that opportunity to refinance or reposition it in some way in the future. And our investors really like that margin of safety. So the return is down, goes lower because of that, but your risk of ruin is far, far less.
This episode is brought to you by Easy Street Capital, the lender built by investors for investors. Whether you're flipping, building a rental portfolio, or executing a ground-up construction project, Easy Street has 3 nationwide loan programs designed to close fast with no surprises. We're talking 24-hour closings, upfront terms, and in-house servicing from start to finish. If you're ready to fund your next deal, go to easystreetcap.com/launch-REI to get started, or you can grab the link in the show notes. It looks like you have everything set up really well today, but there was a point where you did run out of capital. What did that look like, and what did you have to give up during that process, and who did you call? How did you get your way out of that? Because that has to be one of the most terrifying feelings.
Yeah, so once we bought, we bought the 20 unit, and then the first time we ever brought on any partners at all, we bought like this, it was some 2 to 4 unit properties that were all in the same block owned by the developer. So it was 14 units total. I think it was 3 or 4 buildings. And we brought in 2 partners, and that was the first time we really did that. But we had to do it because we didn't have enough funds to like keep buying. And then after that, we totally tapped out, right? And so, we kind of waffled for a year or 2 on what to do. We had always said, well, we could raise money. The problem is my buddy's a financial planner, and there's this concept of selling away. And so he couldn't raise money legally the way his entity was structured. So it took him, I think, about 8 months to jump through a bunch of hoops to become an RIA. And that allowed him to have this other business where he was raising funds from investors. So that was a big leap for him because he didn't know if it was going to work. It was risky to his main business, but it's what was able to get us to that next level. We knew that we had to raise money at some point on that. Otherwise, it's just, well, we could wait 5 or 10 years for more appreciation and debt pay down, and then we can refinance. Now, we did do that recently. We bought a 40 unit, just me and him, just a couple months ago. By doing that, we repositioned our personal portfolio, took all the equity out, so we were no money out of pocket, and we were able to buy a 40 unit building. But you can't do that every year. You have to wait for that to snowball a little bit. So we did know that, yes, if we want to grow, if we want to continue to do this, that's going to be the way to go as far as scaling. Is we have to bring in investors and go after bigger properties, which is the direction we wanted to go. It's just we were hamstrung by where we were at.
And now we covered the process of money coming in and being able to raise all this capital to really go large scale with the deals that you guys are doing. Now let's talk about the other side of that. You guys have paid out over $500,000 in distributions to investors over the last 18 months. What did it feel like the first time that you wired money to someone else who trusted you with their capital?
It's an incredible feeling. And that was part of the reason too, is like, not only did we want to scale, but we wanted to bring in friends and family and colleagues to enjoy the benefits of real estate alongside of us. So really all of our investors, we know them personally. They are close connections of ours. And we've, grown organically a little bit. We meet new people. They bring in, their cousin, their uncle, their dad, whatever it is. And we meet these new people and it grows that way. So it's an incredible feeling that they put that trust in us initially, right? They don't know if they're going to get a distribution. That's our intent. But then, sending out those first distributions feels really, really good. They love seeing that ACH hit their account every quarter and getting their K1s so that they can take advantage of that and offset some of their income. And they just like being part of it, because a lot of people that invest passively, either they don't have the time or the knowledge or the desire to actually just go buy a duplex and manage it themselves, right? But they want that diversification. They want that that feeling of ownership, especially with like a physical asset. And that's why, real estate is just a powerful tool, because again, people understand roughly how it works, even if they've never done it.
And you're doing all these deals and managing these remotely. Has there ever been a week where everything went wrong at once, whether it's tenants, issues at the property, and you're like, I just can't even believe that this is happening? Any just absolutely insane stories with the property that you guys own or some tenants?
I mean, I would say that happens frequently, and it becomes more normalized. The longer you're in real estate, you're just going to see so much stuff. I mean, like we had a fire in one of our apartments. Didn't surprise us, right? It's just like
tell me what happened with that. What happened when the apartment building caught on fire?
So that was our 20 unit. Thankfully, it wasn't like one that our other investors were in. So it was one of our the personal ones. But yeah, the guy, he said he fell asleep. He was probably blackout drunk. He left something on the stove, and his entire unit was affected. Obviously, we kicked him out. Redid the unit, looks great now, and it's rented out, but and insurance paid for it, right? It's just, and again, this goes back to having a rockstar property manager. We didn't have to deal with the thing. He interfaced with insurance for us, got the whole thing turned, took care of it. And in a perfect world, that's how it goes. That's not always the way it's going to go with some people, but having issues like that, of course, having people pass away in your units, and that's super sad, but it's just part of it, right? This is part of life. And so, there are definitely some situations that come up, like right now we're dealing with some challenges at our newest one. Just some vacancies, some stuff that we did anticipate because we knew we were going to have to evict a couple people after inheriting, a bunch of tenants, right? So we knew a couple of those, but then there are a couple other vacancies. And then all of a sudden it's like we had to replace 6 HVACs. So all of a sudden it's like, rents down, $40,000 out the door for HVACs, stuff like that. And some of it's par for the course. And then some of it's like, well, what can we do better here? Do we need to do a better job at marketing the property? Do do we need a better HVAC tech? Like if he's just saying replace everything, but it really we could fix it for, $700, like what does that look like? So kind of getting down to the nitty gritty in operations, what does this mean? Does this mean that they just neglected the property so much, this is where we're at? Or is there something we can do better and address this in a more efficient way?
What's the most expensive mistake that you've made at scale so far? A number that even just hurts to say out loud.
Oh boy, let's see. I'm trying to think of a situation. I mean, we've been very blessed with at least the most recent purchases. We've had other issues. Dealing with a lender that didn't have our best interest in mind. Let's just put it that way. It took us an extra 2 months to close. We had everything into him from the get-go. We had to put an extra $25,000 hard. And then the day before closing, we realized it's not the terms that we agreed to. And then after we closed, we just closed. It's like, okay, well, we have to close or we're losing $50,000. So we closed. And then in that, that stack of documents, it's like, that thick, the mortgage docs, they had slipped something in there that said that we had to pledge more collateral to the bank.
How did the lender
effect?
How does the lender, that can't be legal, right? And then also like, how can the lender not have your best interest at heart? How can that be structured that way? Or how can that even happen?
Well, shame on us for not reading all those documents, but when you're closing the next day and it's like, we need these FedEx today, it's like you just go and there's like, 14 notary, signatures and all that stuff. I don't have time to read it. I don't have time to send it to an attorney to read it. And we had worked with this lender before. So, we're just like, we need to close this. Otherwise we're out $50,000. Right. And then the terms were not what we had discussed, but we're like, okay, fine. We'll just refinance in 3 years because we're hoping for a 5 or 7 year term. They gave us a 3-year term. The rate was what they said. So that was good. But then buried in those documents, and they didn't say this when we were going through all of it, that we had to pledge extra assets. And we just said, no, we're not going to do that. Like it already was underwritten and you buried this in the paperwork. And so, tough lesson to learn there, but now we're refinancing right now with another bank. We're going to have to pay a prepayment penalty on that loan as well. So I would say that's the biggest pain we felt in the last year, is dealing with that, but learning some lessons, right? You're in the game long enough. You're going to learn some of these tough lessons. Not everyone is out there to help you. And you got to vet who you're working with. And sometimes you have to move on.
And you are now brokering loans, I think, in all 50 states yourself. So at some point you pivoted from working as an agent for the actively earned income to brokering loans, which probably gives you a big advantage on some of these. Are you doing loans on the commercial side mostly, especially for the deals that you guys are doing? Or are you doing loans on the residential side, or is it a mix of both?
I'm mostly residential. I looked at it as kind of like a full circle moment, like starting out as an agent, getting into investing, now being on the lending side. That's kind of like, I've done everything except, be a home inspector, right? It's kind of like a lot of different angles in the industry. And I'm still learning a lot on the lending side, to be honest. There's different requirements with different loans, different states, different products. So I'm mostly residential, though. That's more of my focus. I do like some non-QM stuff, like in the residential space, for people doing, fix and flips, for, DSCR loans, STRs and stuff like that. So definitely touch that, but I haven't really gone into the commercial space. I've seen how difficult those loans can be and how many hoops you have to jump through. But I really like working with my referral partners, which is mostly real estate agents. And, because I've been in their shoes, right? I know what it's like, and I treat them like, they're more my client than the client is, because I know that their purchase really depends on the lending, 80% of the time. And so, I try to bring as much value as I can. I think it's a given that you should get a pre-approval quickly and you should close on time, right?
Yep.
as long as that happened when I was an agent, I was like, okay, we're good. But one thing I realized is I never had a single one of my lenders bring me a deal ever. I was bringing them all this business, and they weren't, I mean, yeah, they were taking care of the client and getting the loan done. Like I said, that's a given, but they never brought me an opportunity. And I just kind of mold on that. I'm like, how can I as a lender be different? Right. And so what I do for my realtor partners is I tackle their past database, because a lot of them are too busy to do that. And so whatever they want to get hand over to me, whether it's new leads, old leads, past database, I call on them and try to find them buyers, sellers, referrals, reviews, all that kind of stuff. And that adds a lot more value to them outside of just the loan. I'm actually bringing them a couple deals a year, depending on how big their database is.
I think it's really cool that you took that creative approach, because most lenders certainly don't do that. And it seems like you've been willing to continuously dip your toes into new things and be exploratory and learn how to do new things that are related to what you were doing, but it's technically a new area, and you're getting all this cross-functional experience from sales to loans to multifamily. And so, you're really covering a lot of bases here. And I think that as time goes on, the benefits and the synergy you're going to get from this is just going to compound. What does your team look like today on the investing side, particularly around multifamily? I know that you've got that one property manager. You mentioned in the one business that you've got a partner. You mentioned you've got the other business. Do you have a legal team that's helping you around setting up syndications? Do you have, marketing department around any things that you're doing? Could you kind of give me a picture of how many people now work on the team and what things look like?
Yeah. So, me and my buddy, we, like I mentioned before, 76 units. That's really just me and him. And so it's the team that we've kind of assembled with the property manager. That's the biggest part of the team, really. And now we're working with a new lender too, that's helping us do some refinances and things like that. So really that's us two plus a couple other people. Of course, there are many other people in the background. On the bigger multifamily, we have 5 general partners, myself included. And some people, that might sound like a lot, might sound like little. I'm not sure. I don't know how some of these 1 and 2 person shops do it, because there's so many moving parts. So I'm grateful to my 4 other partners, because they bring different skill sets, different spheres of influence, things like that. Like a couple of the guys are just so good at raising money, really good with numbers, marketing, whatever it is. Like we all kind of fill different shoes there. And then we have, like you mentioned, we have a couple attorneys that we work with. They help us put each deal together, because each deal is separate. So we're having to, form, 4 new entities for each deal, set up new bank accounts for each new deal and things like that. I would say it's probably not far off where we're going to have to hire somebody internally just to help keep up with admin stuff, right? Because there's so much stuff to keep track of, the bank accounts, the just stuff like getting the K-1s filed in an appropriate amount of time, interfacing with the attorneys, interfacing with the property managers, so there's a lot of different things that we've been doing, but I think it's also important to learn yourself so that you can train somebody. And so I think we're getting close to that point where 1 or 2 more deals, we will probably need to hire 1 or 2 people to help us out with the day-to-day, because it does, stuff like insurance renewals. So much stuff goes on in real estate, right? And we have investors. We have a fiduciary responsibility to them to provide them with a good, safe return. And we need to make sure that nothing gets, lost.
There's someone that might be a potential fit for that, but follow up with me when you guys go to hire. And if they're still looking for something, then I can let you know. So definitely circle back with me on that. But let's move into a little bit of rapid fire here and then talk about what's next for you. So what do you think is the best market to invest in right now if somebody's starting from zero?
Ooh. It always depends on what their goals are, right? Because I always like to reverse engineer things. If they're just focused on long-term wealth building, I would say go to like a middle market. And what I mean by that is like, don't go to the cheapest one where you'll find that cash flow. Like you can go like to Memphis and go find, a bunch of cash flow, but at what price? It's a tough market to manage. Or like, you go to California and you're only really playing the appreciation game. So I would go to a middle market, like, something that's good, that's growing. I mean, like I said, we're in Alabama. We like it. It's landlord friendly state. That's going to be my first place. I'm always going to start. Landlord friendly state, good place to do business. And then look at, what does stuff cost? And can I even hit that 1% rule anymore, depending on if it's smaller or bigger, whatever that is. So markets like Tennessee, Alabama, Florida, South Carolina, North Carolina. But the Midwest is really appealing. It's been very steady. It hasn't gotten hit like the Southeast and the Southwest have. And I grew up in the Midwest. And so we're always looking everywhere. As long as it's a landlord-friendly state. I mean, right now we're looking at some opportunities in the upper Midwest. So it does kind of depend. But if it's wealth building, try to find that middle market that is growing and has a decent population base, and start to get to know agents, property managers, things like that. If you want to go more of the active route, if you're flipping, I would say it's better to do that in your backyard. But those are a couple thoughts I have there, and I would be happy to chat with anybody if they wanted to actually like really discover what that looks like. Because like I said, we'll just reverse engineer it.
Two more quick questions. One of them is, what's the biggest red flag to look out for when you're evaluating multifamily deals? Or if there's a few that come to mind and they're kind of equal, you could kind of rattle them off.
Yeah. Red flags. I mean, sometimes a red flag can become a green flag. I'll say that. Like, what we look for is typically operational inefficiencies. So like one of the properties is actually the first big multifamily that we purchased with Missional. When we toured it and we're doing our due diligence, the developer's daughter, so the developer still owned it, she was the property management for that property. So she lived on site. As we were walking the property, people are like, hey, did you get that maintenance request that I sent 2 weeks ago? And just the way she responded, and just like that alone, like 2 weeks, like nothing should go 2 weeks. I don't care what it is. We knew, that would be a red flag if you're like an investor in that deal. You're like, I don't know. Like, she just was not a professional. She was daddy's little girl just managing the property. And so for us, that's a huge win for us, because we know that we can get a better property manager in there, manage it more efficiently, get to maintenance requests, in 24 to 48 hours. And what we got after that was just huge thanks from the community. Like, hey, all my stuff is fixed. It's going well. It's a better process. It's more technology involved, and it's friendlier for them. So, I mean, that's a couple thoughts I have around that.
Okay, actually two more, because these ones are just too good to let go of. The next one is, what's the best deal you've ever done? How good can the numbers really look on a multifamily deal if you just crush it?
I mean, I would have to say it's that 20 unit, that first apartment deal that we bought. I mean, because we were able to get it 100% financed, and within.
What do you think the ROI looks like when you kind of look at it?
I mean, I haven't even calculated it, but it's. I mean, and then we did ride that wave of appreciation, right, between 2018 and now. And so to get it at such a good basis, and then you see a run up and, have it more than double in value in just a few short years. Like, I mean, that's been our biggest home run, not just because of the numbers, but that was really the better part of it, was that it got us into that relationship with the property manager and to that market. Because we're going to continue to buy in that market for decades.
And then the last one is, let's pretend that we've got a little time capsule and we can teleport you back to when you were at your dead end marketing job that you hated. You can only tell yourself one thing. What is it?
Go get your real estate license. I mean, that was the thing I was missing. I just lacked a little bit of vision and action. And it took a bit of like, not back against the wall, but things weren't going as well or as smoothly. And I really had to, figure out what I was going to do. So yeah, I think that's a huge one.
I think that a lot of times people will go get their license as a real estate agent. They'll work as a realtor for several years. They'll just kind of get stuck in the monotony of it and they'll just keep doing that, but they won't develop any further skills or do anything else. It is so critical that you either start a business after that or get into owning a brokerage or a local office. You start a property management company, or you start getting into investing with multifamily or storage units, whatever it is. But you have to take the knowledge that you have about real estate and about transactions working as an agent and be able to parlay that into the next thing where you can build extraordinary wealth and have ownership that being a realtor doesn't give you. I think 98% of agents do not take that next step, and that is what's truly going to give them financial freedom and unlock the next level in their life. And that's exactly what you did.
I totally agree. I think it's a shame that more agents don't realize the opportunities that they have, right? What, like you said, like not even just the investing side. I think they should invest, but yeah, you could own the brokerage. You could start a team. You could own a ancillary business, own a home inspection business, own a painting business. There's so many ways. I mean, I always say the great thing about real estate is that there's a million ways to make money. The problem with real estate is that there's a million ways to make money. But like you said, get good at that one thing first. Like, yeah, you get good at being an agent and then maybe it's getting a little boring. But at that point, you can set up systems and people to take care of that. And then you go figure out the next thing and keep growing.
So to recap here, you've got 264 units. You've raised $14 million in capital. You guys are continuously acquiring multifamily properties. We didn't even get to this, but you gave away $40,000 to charity as well, and I'm sure that number will skyrocket. You also gave out over $500,000 in distributions to investors. We will certainly have you back for future episodes where we really get in deep of how you're actually doing these deals one at a time on a tactical level, and I'll be really excited for us to do that in the future. But for right now, where can people learn more about you and find your stuff that you have to share with everyone?
Yeah, so if you want to learn more about our capital group, it's called Missional Capital Group. They can go to missional.group, sign up for our newsletter there. That will, we won't spam you. It's just, kind of an opportunity list. We do send out an occasional email on what we're seeing in the market. But if you want to, be a passive investor alongside of us, best way to do that is sign up for that newsletter. Other ways, if you want to get in touch with me personally, just go to nateshields.com. There's a couple ways for you to work with me there.
Nate, thank you so much. We appreciate your time today.
Absolutely. Thanks, Vince.
If today's episode was useful, subscribe so you don't miss what's coming. We drop 2 episodes every week. And if you want to go deeper, join thousands of investors getting our free weekly newsletter at newsletter.launchREI.co or check the link in the show notes. See you next time.